We did hear those comments from the President overnight, lashing out once again at Jay Powell at the Fed. Do you agree with his comments that the dollar is too strong? And I guess, if so, how does that impact your investment decisions?
Well, I think we've got to ask ourselves why he's commenting on the dollar. He clearly wants it weaker, of course, to boost exports and continue growth in the economy. I think the U.S. is doing fine. I mean, growth is good there. And I always say on fund management, you ignore the U.S. at your peril. It continues to do, the stocks there do continue to do well.
Speaking of stocks doing well, you said last year Equities the best investment for 2019. We've seen such a healthy correction, which is great for your business. Do you still stand by that call?
Yeah, I think so. I mean, I think we're going to hopefully go back to more what I would call normalized markets now that quantitative easing has sort of officially almost finished. And I think that brings back stock pickers. So a business like ours, which is sort of bottom-up stock picking style, more tending towards value rather than growth and quality, had a tough time the last few years until the last quarter of last year. So it's been, the markets are, I hope, turning back towards active rather than a more passive style of management.
And does that continue when we start to see the fact that the U.S. China trade relationship is thawing somewhat? We're getting, at least by the headline news, closer to some sort of agreement.
Yeah, I think hopefully we will get some sort of agreement. I think Trump would like to reach agreement. I think it's whether he can now take the hawks in his own, the more hawkish members of his own government there who really are more, tend more towards being anti-China than he probably is.
Is that still the greatest risk, or is the fact that we are now March 4th, March 31 is very fast approaching, is Brexit a greater risk, do you think?
No, I think America and China is a much bigger risk than Brexit. Brexit's a more localized risk, I think, for the UK, clearly, and probably a bigger risk for Ireland than anyone else, because their supply chain comes in through the UK, and you see predictions that if there is a hard Brexit, Ireland could see a significant slump. But it is a risk, and it's a risk for Europe as well, because a lot of their exports go to the UK. There is a big trade deficit, as you know, with the UK, which is very significant.
What about in terms of what businesses are going to do? If fund managers stay in London, is that, I guess, a positive outcome?
Yeah, I think the fund managers are staying. What we've all done in the fund management world is locate businesses in Dublin or wherever, and we already had businesses in Luxembourg, which is where our funds business tended to be located. So as far as fund managers are concerned, they're sort of reasonably well prepared for a hard Brexit if it came to that.
And what happens to sterling then?
I think sterling weakens a bit. There is certainly, I don't feel there's anything in sterling that's towards a hard Brexit. I think most people in the UK still think some sort of deal will get done. Most deals, as you know, in negotiations get done at the last minute when they have to reach a deal.
Let's talk about your business. There was a huge slump in your stock price last month when Mitsubishi UFJ sold out of the business. It sort of seemed like a thumbs down from investors about the merger of Standard Life and Aberdeen. How did you read it?
No, well, I mean, Mitsubishi have been a long-term shareholder of ours since about 2008. And when they bought a business in Australia last year, and Mitsubishi told us then that they would sell the stock. Obviously, when you place such a large stock at 5% discount, but it's got most of that back already. So no, it was a strategic decision of theirs, and as you know, they said in the announcement that the very strong relationship continues with Aberdeen Standard Investments.
What does the merger mean in terms of further job cuts?
I mean, the job cuts were already factored in when we did the merger between the two asset management operations. And the industry as a whole is going through a tough time. So I think that what we what we certainly feel is that we got ahead of the game in doing this merger because we saw these tough times coming in the industry. Pricing's coming down, tougher markets, more and more passive, active to passive. So it's going to be tough this year as well. So we think we're ahead of the game.
So tough in terms of there could be further job cuts?
No, tough in terms of revenues. Yeah, I mean, you can never rule out making your businesses more efficient. But as I say, I think the great thing we've got is because we did the merger, it gives us scope to where there was duplication to cut costs. So and a lot of it's technology as well. A lot of it was the technology back office and so on. But they were very complementary businesses. One was the leading UK savings brand, and we were strong in Asia.
You touched on duplication there. You're a co-CEO. It's not popular with shareholders. What's the likelihood you return to one CEO?
Well, I think, luckily for me, I don't need to make that decision. That's up to the board to decide when they want to make that change. I think that that it's co-CEOs, so we have very different responsibilities. Keith tends to do more of what I would term the running of the business, so or running of the asset management side of the business, whereas I do much more of the client side of the business. So we're very complementary strengths, and it certainly works for me.